Okay, we are on video number 9 already, which is pretty crazy because I remember when I first tried to do this about 5 months ago when I first started my YouTube. It took me like a month to film 10 videos, but we're already like a week and 3 days or whatever the hell. And yeah, we're already at video number 9, which is cool. But again, we're going to be going over liquidity in this video. I'm going to try and help you guys identify what liquidity is, where it lies, and how to use it to help you guys get better entries on your trades. Again, we're just not going to base our trades off of a liquidity sweep. That's when we're going to start using the confluences that I will teach you guys longer in this Mastro Futures Trading 2.0 blueprint thing. Holy crap, that's a lot of words to say. But again, you just don't enter trades off a liquidity sweep. We're going to show you guys how to actually enter off of trades in the future. But again, we just want to go over this video to identify what a liquidity sweep is, what liquidity is, where it lies, and how to identify what it is in the market. So what you guys should be doing after you guys learn this is going back and back testing and just learning how to identify where liquidity is, where it lies, and just know what liquidity is. So let's get into the video. Okay, so in this video, I already have the definitions written out for you guys. It literally took me all day to do this. So again, I go back in all my notes that I have, and I'm putting them together for you guys to get you guys the correct notes so you guys can understand it better and write them down in your notes to help you understand it instead of me just sitting here typing it out for you guys. And it saves me time not having to edit the video, and it also saves you guys time to see the bullet points and the stuff I already went through today. So again, I have this Google Doc here that I have my notes on, and I can, if you guys in the comments want me to share this in the Discord for free, I can. But again, I'm going to bring it into the screen right here for you guys to show you guys the notes. And then we're going to take it out, and I'm going to show you guys the examples on the candlesticks and draw stuff out for you guys so you guys can understand it better after reading the notes. So again, I wrote these notes. I don't give a shit what anybody says. I literally went back, and I have a bunch of studying notes and everything that I've been trying to put together for you guys for this 2.0 blueprint, just so you guys can see it in some of these videos instead of me just sitting there typing it out and taking forever or having to edit it, just so we can have best of both worlds on this. Okay, so first thing I want to go over, and we'll bring this little guy in here just so you guys know, and make sure you guys have your notebook out so you guys can read it. So again, you know what can we do? Can we do this actually? I wonder if we can. No, it's not going to work. Never mind. I was going to see if we could just stack it on top of each other, but that's not going to work. All right, so what we're going to do here is, first off, we're going to go over what liquidity is. So liquidity refers to pending and resting orders in the market. These orders that are waiting to be triggered, such as stop losses or pending entries. All right, so we already went over market trends in the last video, correct? What we know is, let's get this out of here. We're going to draw it for you guys. We have an uptrend. Bang, we'll make that green. And then we also have a downtrend. All right. If we listened in the other videos, we know that an uptrend consists of higher highs and higher lows, and then a downtrend consists of lower highs and lower lows. So where liquidity would lie on an uptrend would be above the most recent high. Why would there be liquidity at these areas? So liquidity would be at this area because, again, or not again, because we would have, people would see that the market is continuing down, correct? We have retail traders who are just going to press sell at this area, right? So we'll have one form of buy orders that are going to be filled in this area because, again, they're most likely going to put their stop loss above this most recent high because in case price wants to push back up, it's going to stop out their order. They're going to have to buy back their order because, again, they're selling it. They're going to have to buy it back because their stop loss is going to get hit, and then the price is going to continue in an up direction. So there's one form of liquidity there, and then we also have the people who are pressing buy thinking that price is going to continue up in the direction because, again, we are in an uptrend. So we have people who are filling buy orders for price to continue up at this area, and we also have people who are filling in their stop loss orders because they're predicting the market to go down, and their orders are going to get filled because they have to buy back their position once their stop loss gets hit. Okay? And we'll go in depth with that again. I'll put the notes up because I have it written out for you guys. Just want to go over it real quick. And then the other thing is when we are in a downtrend, we consist of lower highs and lower lows, right? So where would liquidity lie here? We have people, retail traders, right, who are going to be pressing sell in this area for price to continue lower, and their orders are going to get filled. And then we also have people who are going to be pressing buy, right? And they're going to be putting, let's say price is slowly starting to continue up. They're going to think, hey, I'm going to get close to bottom ticking this buy position because price is going to start continuing an uptrend. Most likely it's going to continue up, right? So I'm going to put my stop loss right below this low just in case price wants to come back down and continue in a downtrend. So what's going to happen when price continues in a downtrend? Those stop loss orders are going to be filled. They're going to have to get their position bought back, correct? So those orders are going to be filled, and then the market's going to get filled with more orders to continue price in the down direction, and we're going to continue in a downtrend. Correct? Boom. So that's a little information right there. Liquidity lies above highs and lows, and we're going to get into it even more on what time frames are best for liquidity to look for. You can find liquidity on every single time frame, but again, we're not going to be just wanting to enter off of a liquidity sweep, and we're going to have to remember that higher time frames hold higher power when we're looking for these liquidity sweeps, correct? Cool. So again, as I say liquidity sweep, I'll bring this back over here for you guys. You can write it down in your notebook. You can pause it, whatever you need. So what is a liquidity sweep? A liquidity sweep happens when price runs into and takes out these pending orders, which fills them, correct? What I was just trying to explain there for you guys. So after sweeping out liquidity, price often moves in the opposite direction because large players, like we have the banks, the hedge funds, the bigger institutions, all these guys with the big money that are moving the market, they're going to sweep out all those orders. They're going to enter in their large position sizes because, again, they want to enter at the best price. They want to fill their orders at the best price in all of their orders to end up pushing the price in the opposite direction, correct? All right, so they use the player's order, like retail traders like us. They use our orders to get stopped out to fill their own positions to continue price up in the direction they want it to go, okay? So again, where does liquidity lie? Liquidity typically rests above highs and below lows in the market. Why? Because that's where most traders place their stop losses, where we were explaining before, which become pending buy or sell orders. And also we have breakout orders like buy stops above highs and sell stops below lows. Correct? Right? So we have an example of the uptrend for you guys right here. Here, we'll just copy this for you guys right here, and then we'll paste it. Just so we can go over the example again one more time for you guys and show it. All right? So look, we are in an uptrend. Bang. We'll make this green. You guys can see that, right? Yes, you can. Okay, so we are in an uptrend, right? So in an uptrend, we see higher highs and higher lows, and you guys should already know that from the video that we just posted before, or a couple videos back. So what we see, retail traders do two things. We're retail traders, right? They buy when price breaks above a high, like I was saying before. So people are going to be taking a buy position, let's say, when price breaks above, let's make this better. Let's go back. When price breaks above this high, right, we have people pressing buy right here, right? So when price breaks above a high, they're adding pending buy orders above the highs. Others try to catch a reversal by selling, placing stop losses above the highs, which turn into buy stop orders when hit. Then we have other retail traders, correct? When they see, let's say this high gets pushed above, right? They're trying to see, once price starts to move down, they're clicking sell. So they're putting their stop loss order, like I said before, they're putting their stop loss order right at that high, thinking that, hey, if price comes back up, we're just going to get stopped out, right? But we want price to continue down. Hopefully it goes into a downtrend because they're retail traders. So what ends up happening is price continues up in the uptrend. They get stopped out. Their orders get filled, and price continues in the up direction. Correct? So we have two types excuse me, of buy orders in that area. Right? So above highs in an uptrend, we have buy stop orders from breakout traders, and we also have buy orders from stop losses being triggered on short positions. Okay? So we'll put that there. Now, let's go over an example of a downtrend. I have it already written out for you guys, so I don't have to type all this stuff out. Trust me, I already tried to film this video for you guys, and it ended up being like an hour and 50 minutes long of me just typing. So again, if I had to type all this stuff out, it would just take a lot more. So I got it down for you guys. We'll copy and paste it right here. I promise I wrote these notes. Got it? So look, we are in a downtrend now. Okay. We'll make this red. Okay. So in a downtrend, we see lower lows and lower highs. Correct? We're moving in a downtrend. We already know this. We already learned this in the last couple of videos. So what we see, retail traders, they sell when price breaks below a low, adding pending sell orders below lows. Correct? So price breaks below this low, we have people pressing sell. They're predicting the market's going to continue in a downtrend, right? So below lows in a downtrend, we also have sell stop orders from breakout traders. So remember, if we hit this low, let's say, we have people who are going to enter a buy position in this area. They're going to think price is going to continue up in an uptrend as retail traders, put their stop loss below this low, and then price is going to continue down, take out their stop loss orders. More people are going to fill their orders to continue price in the down direction. So sell orders from stop losses on long positions also. Correct? So there's two forms of sell orders that are going to be resting at the lows in a downtrend. Okay? Cool. That should be enough for you guys to understand. Okay, so let's bring this out here because you don't need to type this one. Where specifically does liquidity rest? So liquidity is commonly found, all right, you're going to write this down in your notes, at high time frame highs and lows. So we have 4-hour highs, we have 1-hour highs, and we also have previous day highs and lows, right? And that's going to be the third bullet point right here. We also have session highs and session lows. So we have Asian session, London session, and New York session. And we're going to go over that in the chart also. And then we also have 15-minute highs and lows that are going to be lower draws in liquidity for, let's say, retracements to continue another direction. But we're going to go over that in a future strategy video, I promise. Like if we do a PM session video, I usually use 15-minute highs and lows to identify where the PM session is going to go to target higher time frame draws in liquidity. Okay? And then we also have equal highs and equal lows, also called relative equal highs and lows. And we'll actually go over that right now. We'll go over the equal highs and equal lows. So let's go over, excuse me. Let's say that the market has equal highs like this. Okay? So instead of one form of buy orders right here and stop loss orders, we have two of them, which makes it even more stronger of an area for there to be a liquidity sweep or price or market makers or the banks, whatever you want to say, to go up and target those orders, to fill those orders and then continue price in the opposite direction, right? So let's say we have a bunch of orders up here that need to be filled, right? Let's put this down a little bit. We're equal highs. We have a bunch of orders in this area that need to be filled, right? What the market makers are going to do, they're going to want to push price higher, take out this draw on liquidity, fill all these orders, and then they're going to push price in the opposite direction to continue down to, let's say, a higher time frame draw on liquidity, a session low, let's say previous day low, and stuff like that. And we'll get into targeting those draws on liquidity for take profits and stuff. But again, let's say we have equal highs. Now let's do the opposite. Let's say we have equal lows. So we'll form equal lows. Right, we'll have price going like this. We'll move this up here. We'll make this red. So look, if we have equal lows, right, we have a bunch of pending orders down at this area. If this was a draw on liquidity already, just even at this one, now we have two that are equal lows. That makes it even more powerful for the market to want to come down and take out these orders and fill them and then continue price in the other direction. So what is it going to do? Market makers are going to push price down to fill these orders. They're going to stop all those people out, fill all their orders with their orders, their big chunk of orders, to push price in what? The opposite direction and target either a high time frame draw on liquidity, session highs, or let's say previous day high, or let's say Yeah, we already said high time frame draw on liquidity, like 4 hour, 1 hour draw on liquidity. Correct? All right. So there's equal highs and equal lows. Let's go over what relative equal highs are. So we have these notes over here. You guys can see those, right? Okay. So look, we also have something called relative equal highs and lows, and they're considered low resistance draws in liquidity because price can easily run through them to trigger stops. So again, let's say, right, the market's trending up. We're in an uptrend. Okay? It doesn't matter if there's 2 or 3 or 4 draws in liquidity, right? On all these draws in liquidity, we have resting orders, let's say. So we'll make this green. Let's say the market makers, they want to see all these draws in liquidity, right, that are stacked up on top of each other. These are considered low resistance draws in liquidity. Sorry. Low resistance draws in liquidity. So the market wants to target these orders and push price in the opposite direction. If price is stacked up on top of each other, let's say these are all hourly lows, correct? This is usually going to be a big draw in liquidity. The market's not just going to take out one order and then continue price in the up direction. Usually the market's going to target all of these orders because they can fill a bunch more of their orders. They're going to come down, take out all of these orders, and then they're going to push price up in the intended direction. Correct? So let's say this is New York market open, correct? Right? And we have all these 1 hour high time frame draws in liquidity below. What are the market makers going to do? They're going to push price down, right? They're going to push price down so they can fill all of their orders to continue price in their direction to where they want to get their take profit and stuff like that, right? So we target high time frame highs, previous day highs, session highs, blah, 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 whatever, right? But usually if you have low resistance draws in liquidity, and low resistance draws in liquidity are usually a bunch of, let's say, hourly highs or lows stacked up on top of each other, 4 hour highs and lows stacked up on top of each other. You have 15-minute draws in liquidity stacked up on top of each other. Usually those are a high time, like usually that's a high draw in liquidity for market makers to come down, take out those orders, fill their orders so they can fill a big chunk of their orders and continue price in the intended direction. Correct? So let's say, we'll X this out. Let's say we are in a downtrend, right? We are in a downtrend. We have market open right here. So let's say market opens right here. We have an hourly high right here. We have an hourly high right here. We have an hourly high right here, right? Actually, let's even make them closer, like this. Let's say they're stacked up like this. So all these relative equal highs, right? They're stacked up on top of each other. So if the market makers want to push the market to the downside still, what are they going to do? They're going to stop out all the retail traders and all these stop loss orders right above here so they can fill more of their orders, correct? To push the market in the intended direction to the downside. So what are they going to do? Market opens. They're going to push price up. Fill in all of their orders, stopping everybody else out so they can fill their orders. They're going to fill their big chunk of orders, and then they're going to continue price in the intended direction all the way down to either a high time frame draw on liquidity, like a high time frame low, 4 hour, 1 hour low. You have 15-minute lows, like low time frame draws on liquidity, 5-minute lows, and you also have session lows, like Asian session lows, London session lows, or previous day low or something like that. Correct? Bang. So there's relative equal lows and low resistance draws and liquidity. So that would basically be going over low resistance draws and liquidity. Even if you have, like, let's say a high like this. We'll make this green. Let's say you even have a high like this and they're pretty close. Again, you have liquidity right here and you have liquidity right here, and they're pretty stacked up with each other, even with two of them. Market's going to do the same thing. Their market makers are going to want to push price up, fill in these orders by stopping everybody out, and then continue price in the intended direction. Correct? Pretty simple. Pretty easy. All right, so what I want to go over actually before we end up going into the candlesticks is I want to use just explain what session highs and session lows are. So let's see. Let's go on the 30-minute time frame. I mark out session highs. So we have Asian session. Asian session I mark out at 6 p.m. EST. And then we have London session. I mark out at 3 a.m. EST. Oh, that's the wrong one. Now you guys know why I didn't type these out. And then we have New York session. New York session is at 9:30. a.m. Eastern time. So again, I only trade New York session. I don't trade Asian session or London session. I'm going to show you guys these confluences based off of New York session and what time frames to use them in the future videos. But again, this works on every single session and time frame. But again, we want to just target those high time frame draws and liquidity to get a reversal off of session highs and lows, previous day highs and lows, and also even sometimes 15-minute draws and liquidity to target before we get a reversal. So again, you guys can screenshot that, take these down if you guys want to mark out session highs and lows, and we'll go over that real quick here. So again, today we had an example of this. So again, we would mark out New York Open, so 9:30 a.m. And then we have 3 a.m. and then we have 6 p.m. Okay, so look, we have Asian session and London session. As you guys can see, right? Let's see if we come up and, so for Asian session highs, we didn't come up and sweep them out. Where's London session highs? You guys should already know what a high and low is. Is this at 8 p.m.? Yep. Remember, pre-market for New York session also opens up at 8 a.m. So again, this high is literally at New York session, we pre-market. So we literally sweep out London session highs pre-market session. Correct? Cool. So again, as you can see here, we mark out Asian session, London session highs. Pre-market opens up for New York session. You can see price comes up, sweeps out London session highs. We continue down. We get a retrace back into this fair value gap, which we'll go over in the future, I promise. And price continues down in the direction, taking out London session lows, Asian session lows, and then also we have these hourly lows down here that price took out, these hourly lows, and these hourly lows. And perfect. Look, perfect. Look. Low resistance draws and liquidity. Remember, low resistance draws and liquidity are stacked up. As you can see, look. Let's get away from the time frames right now and everything. We'll go over that in strategy creation and all that stuff. But again, look. Price comes down. All these lows are stacked up. All these hourly lows. This is low resistance draws and liquidity, right? We have an hourly low here, hourly low here, hourly low here, right? Market makers push price down because it's a heavy draw on liquidity. So the market traces to that. The market makers bring price to this area so they can fill their orders to continue price in the opposite direction. As you can see, we take out this low, we take out this low, we take out this low, and now the market's starting to continue in an uptrend. Correct? So there's an example on low resistance draw on liquidity. Let's go on the hourly time frame. As we can see here, look, perfect again. This is what you guys are going to go do. You're going to go back and back test this and just identify draws and liquidity just so you guys understand what it is, why it works, and how you can see it in the market. We're just identifying right now. We're not focusing on taking trades just off liquidity sweeps. We'll go over all that stuff in the future videos, I promise. Just bear with me, and I promise we'll go over how to use them. So again, look, we have an hourly low right here. Look, market makers push price down. We end up sweeping out this area. Price continues up in the up direction, right? Let's find one to the opposite side. The market's been trending up that entire time. Wow. So let's look here. Look. We have an hourly high here. We have an hourly high here. Look, literally, guys. This could be considered low resistance draw and liquidity too. Look, price comes up. We target this area. Market makers push price up here. They stop all these people out. They fill their orders in. Market continues in a downtrend. Literally again. Same thing. Where does the market want to target? Let's see. We have these lows. We have these lows. Price continues in a downtrend. We end up coming down, taking out all these draws and liquidity. Market makers fill their orders. We continue in a what? An uptrend. Cool. We can even go to like the 5 minute. But again, we're not going to be taking liquidity sweeps off of the 5 minute time frame. We're just trying to identify where liquidity lies and how it works and how it's reacting off of these levels. So look, what we can see is we have these highs right here. We have these highs right here. Right? Those are literally equal highs, as you guys can tell. Look, literally equal highs. They're basically equal highs. They're just relative equal highs. There's another example right here on the 5 minute time frame. We have relative equal highs right here. Price is starting to continue down. What does it want to do? Market makers see we have relative equal highs. They're going to draw towards that draw on liquidity, stop all those people out. Look what happens. And the market freaking dumps all the way down, continues down, all the way down to here. See, like it works on every single time frame, but right now we're just trying to identify where liquidity lies. Jeez, it gets annoying saying that all the time, I'll be honest. So look, let's say 15 minute time frame. Look at all these draws in liquidity down here. We have these lows. Did it even take out those lows? No, it didn't. But look, we have these lows. We have these lows. We have these lows. Like, look, it literally obliterates all of them. These are low resistance draws in liquidity right here. Look, you got 3 of them. Market comes down, targets all these draws in liquidity, bang, continues up. Right? Like, it works on every single time frame. But again, we're going to put the puzzle pieces together once we start getting on the higher time frames. Let's go to the 4-hour time frame. Look, we have a 4-hour low right here. What does the market do? It starts to continue up. Wait, market makers want to come back down, fill in more orders. They come down, they sweep this liquidity down here. Bang, market continues up. Right? What about here? We have a 4-hour high. Market wants to go down a little bit, continues up, sweeps out this draw on liquidity. We continue down. This is on the 4-hour time frame too. You got to remember, if you scale down to the lower time frame here, and then once we get into our strategy creation, you're going to see we're going to look for a break of structure, a fair value gap fill, equilibrium fill, order block fill, and then scale down to the 1 minute time frame, find your entry. I don't want to get too caught up in that, but again, we'll get into that in the strategy creation. But right now we're just focusing on identifying where liquidity lies and how it works. So again, let's come here. Look at, we have a 4-hour low right here. Here's relative equal lows. 4-hour right here. What does price do? It goes up. We end up coming down, targeting these draws in liquidity. Market makers fill their orders here, push price up. Right? These areas work, guys. So it's just like it's proof. Here's another one right here. Look, we got these lows, and we got these lows. We didn't take out those lows, but we took out these ones. Market's going up. It wants to target an area to fill in more orders. We come down. We fill in more orders. Market continues up. Right? So again, I say it's pretty simple, but again, when I was first learning liquidity, it was kind of confusing at first, but all you guys should be doing right now is going back and back testing and just identifying where liquidity is at the highs and lows and see where price reacts off of those areas, and then we'll get into building a strategy and when to use it and how to use it and all that stuff. So again, you guys can write this down in your notes if you want. We'll move this over here. So why does the market sweep liquidity? Each trading session, like Asian session, London session, and New York session, they bring in new traders and new money into the market. So market makers and large players want to fill their big orders at the best prices possible, like we just went over. So to do that, they have to push price into these areas where liquidity is resting to trigger pending orders or fill their own large positions. Correct? So example, so if we're in a downtrend, market makers may push price lower to fill sell orders like stop losses and breakouts so they can accumulate their buy orders and drive price higher. In an uptrend, market makers may push price higher to fill in their buy orders so they can fill their sell position, then move price down. So again, we have all those people with their buy, sell, stop orders, all those people with their resting orders for the market makers to come up, fill in all those orders by taking those people out. When they take those people out, they fill their orders with those positions, and then they continue the price in the opposite direction. Cool. Quick recap. We'll go over. We can do a quick recap right here. I'll just copy and put it over here that I put for you guys. So quick recap for you guys to put in your notes, right? So liquidity. What is liquidity? Liquidity is pending buy or sell orders sitting above highs and below lows, correct? What is a liquidity sweep? When price runs through these orders, fills them, and then often reverses. So who's filling those orders? The market makers, the people with the big money. They're moving the market in the direction they want to move it in. They're going to stop all those people out, fill those orders, fill their orders in so they could fill in a huge amount of them, and then continue the direction, hopefully in the opposite direction, right? Key liquidity zones: high time frame highs and lows, session highs and lows, previous day highs and lows, and relative equal highs and lows, and equal highs and lows. Got it? Market maker's goal. We're going to go over this again. They want to sweep liquidity to fill large orders at the best price possible, then push the market in their intended direction. Correct? Good. See? Look, that made that video 30 minutes long instead of an hour and whatever it was before of me just typing shit out and spelling stuff wrong in front of you guys. Correct? So again, hopefully I go over enough good information for you guys to understand what liquidity is a little bit. Again, this isn't just going to make you profitable right away just because you know liquidity and breaker structure. We're going to use liquidity, breaker structures, order blocks, fair value gaps, breaker blocks, equilibrium, Fibonacci, SMT divergence. We're going to use all these together where we can put all the puzzle pieces together and use it to help you guys take high probability setups instead of you just taking trades off of breaker structure or liquidity or just taking random trades. So again, hopefully I explained what liquidity is. I tried to get the best of my notes down. Again, if I don't make sense in this video, just tell me in the comments and I'll make another video about this. But again, what you guys should be doing is going back and back testing and just identifying where liquidity is. I wanted to give you guys a definition so you understand why liquidity works and how it does in the markets. But again, go back, just back test, find liquidity where it lies at the highs and lows of high time frames, at session highs and lows, and just look how the market reacts off of those areas so you can see how it works. Then we'll add all the other puzzle pieces together to get your guys' entries by scaling down to lower time frames and entering in trades. I just don't want to confuse you guys right away. I just want to help you guys understand what liquidity is, how it works, what a liquidity sweep is, and just, I don't know, help you guys understand the markets a little better. So again, I appreciate everybody who's liked and subscribed. Hopefully I made sense in this video. Liquidity was one of the biggest things I struggled with just learning the definitions and everything way back in the past. But again, once you guys learn it, it's just like, it just comes to you and you know how the market works. Again, when you have more experience in the markets, you know what to expect, you know what to see, and you just get better as time goes on. So again, I appreciate it, guys. Thank you again for liking and subscribing to my posts. We're going to keep going with this 2.0 series. I think we have we have a lot of more videos to go. We have a lot more stuff to learn. So bear with me. We're going to get this done this summer, and I'm going to bust out all these videos for you guys. But again, if I don't make sense in these videos, just comment below. I'll make a new video for you guys. I love doing this stuff for you guys, and I'll try and explain things better. But again, that's liquidity. Hopefully you guys understand a little bit better. Go back test, identify what it is, and we'll go from there. Appreciate it.